Phil, welcome. Good to have you with us. Let me make sure I'm understanding what you do and how you manage your portfolios. You talk about getting in and out of the market following algorithms. So, are you a classic market timer?
Well, I wouldn't call us a market timer, and the reason I wouldn't is that we don't try to predict what's going to happen to the markets. What we do instead is we attempt to react in the early stages of trends. And this trend actually began in January, where we exited initially out of U.S. stocks on January the 13th. We came in briefly in March and left in early April. And the whole point of what we're trying to do, Tyler, is attempt to be in markets when they're rising, but also attempt to get out of the way of big train wrecks. And so when you look at this market right now, this is starting to look not great. Down 15% on the S&P, 25% on the NASDAQ. And there's a shift in perspective, I believe, which is that people are used to buying the dip. Now there could be these bear market rallies and people could be the dip that's buying, unfortunately. So we think now is the time to be on the sidelines. And yes, we're largely in cash.
Largely in cash. If I want to do something a little more exotic than just be in cash, what kinds of products would you suggest? Is cash just a money market fund, or is it tips? Is it what?
Yeah, so inside of our funds and ETFs, a majority of them were just in cash instruments, which looks like money markets. But there are things out there where you could be. You just saw some looked at, like energy or commodities is a place where you could potentially go. But here's what's interesting, Tyler, is that we're so used to having parts of the market do well and have such quick rebounds as we saw during the pandemic. But what if the opportunity lies just ahead? So for example, even though things don't look great today and maybe not the next week or month, if you are on the sidelines or largely on the sidelines, what that may do is set you up for great opportunities later. And we all saw the rebound in 2020. It will happen again. So I think the key is patience with this market, waiting for it to find a bottom, and we don't know when or where that'll happen. And then once you do, come into potentially really bargain prices.
So how do you distinguish, or how do the algorithms distinguish between a short-lived bear market rally that peters out only to take you down lower, and that final flushing moment where you can confidently feel like, okay, now I'm going to lag into the market? And when you do get back in, how do you do it? What products do you use?
Okay, so within our funds and ETFs, we have just standard indices that we're buying, and typically we're buying blend indices. Mm-hmm. But the answer to your question is we don't know. So if there's a bear market rally and it moves up enough for us to trigger back in, we can come back in temporarily. Mm-hmm. In fact, if you look at 2008, when we were managing through that really horrible equity market, we came back in twice briefly earlier in the year and then ended up sitting out for the entire fourth quarter. So what you need to do is you need to have a system that be agile. When you come back in, you need to come back into things that have gotten beat up the most and just to react to the markets rather than trying to predict what's going to happen ahead. Mm-hmm.